I want to welcome you to the Stock Market for Beginners Ultimate Guide. If you're new to the stock market, then this video will be perfect for you. So I want you to know that every experienced investor in stocks was once a beginner. So it is an honor to guide you in your stock market journey to help you achieve financial success and financial freedom. Now let's begin. So here is what we're going to cover in today's Stock Market for Beginners video. You are not expected to absorb all this information in one sitting. So please subscribe and watch this piecemeal at your own comfortable pace. So let's begin with this. You should invest in the stock market because it is a proven way to grow your wealth. Just look at the historical data. These are the average annual returns that investors make in the stock markets. In the past 30 years, the stock market has gone up by an average of 9.9% a year. If you look at the past 50 years, it's 10.8% a year. In the past 100 years, an average annual return of 10.5% a year. But I'm going to tell you this because I want to be upfront with you. Yes, there are stock market crashes, but over time, the stock market recovers, and essentially, the stock market keeps going up. It's like home prices. Generally, real estate tends to increase in value, so you know this. But I want to make this clear. So here are the median home prices in the past. 100 years ago, a home cost, this is the median price, $3,200. 50 years ago, you could buy a home, the median home, for $33,000. 30 years ago, the median home price was $126,000. And today, the median home costs approximately $400,000. So it just keeps going up. And it's the same thing with the stock markets. The reason why financial assets, such as properties or stocks, continue going up is partly because of inflation. However, the stock market does outpace inflation. But ultimately, you want to put your money to work by investing it, and the stock market has a proven track record of growing your money. Now let's proceed. It is essential that you understand how the stock market works. I don't want you to throw your money in stocks into the stock market if you don't understand the basics. So in this section, let me explain to you what are stocks, how to invest in stocks, how people get wealthy by investing in the stock market, and what stocks are best for beginners. So let's get started. I want you to know that the stock market is very simple. So let me explain to you what stocks really are. So let's just say that you own a business, and so you're a business owner. And let's say that you want to raise a lot of money for your business to grow and expand. So what do you need to do? You need to find investors. And a great place to find investors is in the stock market. Now, in order for you to raise a lot of money for your company, you need to sell a portion of your ownership in your company to investors. And that's what stocks are. Stocks are just units of ownership in a company. So if you buy stock in Apple or Microsoft or Tesla, you are an owner of the company. So you probably own a very small piece of the company, but you are still technically an owner. Therefore, one person does not own Apple or Microsoft or Tesla. So there are thousands of people that own stock in those companies, so those companies have thousands of owners, which are the stockholders. Now let me tell you how to invest in stocks. So the stock market is a big marketplace where you go to buy and sell stocks. To participate in the stock market, you need an online brokerage account. So there are a lot of online brokerage accounts to choose from. I'm going to leave a link down below to some online brokerage accounts that are offering sign-up bonuses with zero fees, and there's no catch. It will cost you nothing. And some of these sign-up bonuses, they can be substantial, so please be sure to check them out. So you open up an account, and then you transfer money from your bank account to your brokerage account, and then you're going to have money in your brokerage account, and then you're going to be ready to buy stocks. So you want to buy stocks in good companies. That's because if a company does well, then the value of the company increases. If the value of the company increases, then the price of your stock goes up. And in many cases, if a company is making a lot of profits, the company will take those profits and pay a dividend to whoever owns the stock. So you don't have to do anything to collect a dividend. It just gets deposited into your accounts, which is pretty awesome. So this is passive income in its truest form. Now, if you want to sell your stocks, it's very easy. So you may want to sell your stocks for whatever reason, such as you just want to cash out. Maybe you don't like the company anymore. Maybe you want to sell your stock to have money to buy a different stock. So you're free to do as you please. And again, this is all free, no fees, zero commissions. So when you sell your stocks, you'll have money in your brokerage accounts because, again, you sold your stocks. And whenever you want, you can transfer that money back to your bank accounts. Or you can let that money just sit there. Some brokerage accounts, they'll pay you interest on the money sitting in your accounts. Or you can use that money to buy stocks, whatever you want. Now, I want you to know that many people get wealthy in the stock markets. And there's not just one way to do it. I'm going to tell you what most people do. And you can try to see which style is most appealing to you. Buy and hold, dividend investor, speculator, trader, and let me explain these styles to you. Buy and hold. Some people just buy stocks and they just hold on to them for a very long time. We're talking about years, even decades. Some people, they'll even hold on to their stocks until they die and they'll put it in their will. So this is a set it and forget it approach. Traders. Some people in the stock market will try to buy and sell frequently and make some money. So these people are known as traders. Traders are not interested in holding a stock for the long run and watching the company grow. So I would recommend that beginners in the stock market, so if you're a beginner, please refrain from trading with a large amount of money. I would recommend that you get some practice in first. But it's true, many professionals get rich by trading, but that comes with experience. Speculators. Some people buy smaller, riskier stocks that have a lot of potential and could skyrocket in price. So these are speculators. I'm not saying that in a good way or a bad way. People speculated on Tesla early on and made a lot of money. So you could say the same thing for Amazon or Walmart and so many other stocks. But there's other people that speculated on stocks and lost a lot of money. So if you're going to speculate, don't invest too heavily in one stock and do not fall in love with a stock. Your emotions can cloud your judgment. Dividend investors. Some people buy stocks primarily for the dividends. Many investors take their dividends and reinvest them to get more dividends, and your wealth accumulates over time. So this is a great way to build your passive income. So you can actually set your accounts to reinvest your dividends automatically. It's called a DRIP, Dividend Reinvestment Program. I am personally a big fan of dividend investing because you literally get paid for doing nothing. So if you're dividend investing, your money is making you money. So you should know from the get-go which style is most appealing to you. And it could be more than one. It could be a combination. But there's no one right answer. There's no one right method. So whichever path you take, you should understand the pros and cons of that method or that style. Now let me tell you what stocks I think are best for beginners. There will be so many stocks to choose from. Small companies, big companies, companies in different sectors, energy, technology, real estate, retail, banking, pharmaceuticals, etc. There will be companies that focus their sales in the US. There will be multinational companies. There are just so many options. I would suggest that as a stock market beginner, you invest in bigger and more stable companies. The reason why I'm saying this is because of risk and reward. If you invest in a smaller, no-name company, there's a higher probability that you can lose a lot of money. As a beginner, you should get a feel for the stock market, take it easy, and just learn. Once you get more experience and knowledge, then you can slowly move out of your comfort zone into stocks that offer more risk and reward. If you don't want to take this advice and you want to jump straight into risky stocks, then I beg you, please do so with a smaller amount of money. Please take my advice. The stock market is not a get-rich-quick scheme. In the stock market, you want to be an investor. You do not want to be a gambler. And I want to see you make money. As a beginner, it is better for you to make a little bit of money than to lose money. So I would recommend sticking with safer stocks to start and learning little by little. Slow and steady wins the race, and it's a marathon. And just so you know, if you want to be very safe and diversify, then you can always buy index funds. An index fund is a collection of stocks. It's like a big basket of stocks where you get diversification. So it's a way for you to buy a little of almost everything, which decreases your risk. Now, in the stock markets, you can choose how to invest your money. So let me give you two options, and you can decide which method that you prefer. So option number one is that you can search for good stocks to buy. This is known as stock picking. So you're trying to pick the winners. If you're going to stock pick, then it's important that you spend time monitoring your stocks to ensure that everything is going well. So later in this video, I will teach you more about stock picking. Your option number two is index funds or ETFs. So if you don't want to become a stock picker, you can invest in index funds or ETFs in the stock markets. If you invest in an index fund or ETF in the stock market, that's like buying a little bit of all the stocks in the stock markets. So there's pros and cons to this approach, which I will tell you about right now. So today, I'm teaching you about index fund investing, which includes what is an index fund, the pros and cons, index funds versus ETFs, and how to invest in them. So let's start with this. What is an index? An index is simply a grouping of stocks or bonds or other securities. So for example, the S&P 500 is an index of the 500 largest publicly traded companies in the US. So the thing is that you cannot invest directly in an index, but you can invest in an index fund. Now let me explain to you how an index fund actually works. So let's say that you have an index fund that tracks the S&P 500. So that index fund will buy shares of stock in all of the companies in the S&P 500. Therefore, the index fund will mirror the performance of the S&P 500. If the S&P 500 goes up 1%, then that index fund, it will likewise go up 1%. If the S&P 500 goes down 1%, then that index fund will go down 1%. Now, I want you to think about that. Really think about what I just said, because there's going to be pros and cons to this. So let me tell you what they are, and we'll start with the cons. Because the index funds will mirror the markets, that means that if you invest in an index fund, then you cannot outperform that benchmark. So for example, if you invest in an S&P 500 index fund, then you cannot beat the markets. So if you want to become a superior investor, an index fund may not be right for you. Another downside with index funds is the lack of flexibility. So for example, if there are some stocks that you don't like in the fund, then unfortunately you're going to be stuck with them. It's take it or leave it. That means that if there are stocks that are underperforming in the index fund, you can't cut your losses and you can't have them sold off. And another drawback is the tracking error. An index fund will not perfectly track an index. So if the S&P 500 goes up 7%, the S&P 500 index fund, it might go up 6.95%. And you may be like, hey, where's the rest? Well, that difference, it includes the cost to run the actual index fund. So sometimes the tracking error may be tiny, like a difference of 0.01%, but with other index funds, it may be much more. But there also may be tracking errors if an index fund uses derivatives. In those instances, an index fund will not track precisely. Okay, so we just got all the bad stuff out of the way, but now let's talk about the good stuff, because there are a lot of benefits with index fund investing. So the great thing about an index fund is that you can be hands-off. You can become a passive investor. And this is great for someone that's new in the stock market or inexperienced. If you do know what you're doing, you're just too busy. Let's just say that you don't have time to research individual companies, or you don't have the time to pay attention to macroeconomic conditions, then this will solve the problem. So I understand that we're all busy, life gets in the way, and this may be a good solution for a lot of people to become a passive investor with index fund investing. So here's another benefit. So the truth is that most people are not good at picking individual stocks. If you're not paying attention to the economy, if you're not staying current on the sector, and if you can't read financial statements, well, that probably explains why. So it's hard for even the professionals to beat the markets. So research shows that from 2001 to 2016, active fund managers underperformed their benchmark index. So honestly, if you put your money in an index fund, then you're probably going to do better than most people. I do want you to know this though, because most people, when they talk about index funds, they overlook this part. So recently, passive investing through index funds, it has been outperforming. However, active management generally outperforms passive investing when the stock market or an index is going down. That's generally because active managers, they capitalize better during the market recovery phase. So in other words, when the markets are going up, an index fund tends to do better. When the markets are going down, active management tends to do better. Now, another big benefit is diversification. Diversification is so important for your investing portfolio because it lowers your risk. Index fund investing provides you with a simple solution. That's because when you buy an index fund, you're buying up a slice of up to hundreds or thousands of companies at once. With diversification, it's going to balance your risk and your portfolio will experience less volatility. Now, here's what I suggest to you. I would say compare the pros and cons and see if this makes sense to you. So to review, the benefits of investing in an index fund, it include but are not limited to passive investing, dependable returns, and diversification. The drawbacks are you cannot outperform the lack of flexibility and tracking errors. So I hope you enjoyed that educational information, but I want to share with you my opinion as well. So I'm going to speak freely. This is like a heart-to-heart about index fund investing. So if you're going to ask me for my opinion about index fund investing, I believe that it depends on the investor. It depends on the individual person. But for most people, for most investors, I believe that index fund investing does make sense. There are more benefits than there would be cons or negatives, because just think about how practical it is. Think about how convenient it is. You could just throw money into an index fund and you don't even have to know what's going on. You don't have to manage it. You could just focus on your job, your career, your friends, your family. You could focus your energy and your attention elsewhere. It'll be more stress-free. You don't have to make these big decisions. You don't have to keep up to date on the macroeconomic environment or company-specific news. So there's a lot of benefits that you have to take into consideration. So sure, the trade-off would be that you're not going to be the next Warren Buffett. So you need to ask yourself those types of questions and be honest with yourself. Are you trying to be the next Warren Buffett? Because if you are, then index fund investing is probably not for you. It's not a good fit for you. Not with the goals that you're trying to achieve. But if you're trying to find a place where you can park your money, excess cash as an investment, and you can do it passively, just check up on it passively, inconveniently, then index fund investing might be a really good fit for you. But I do want to say this last part, and this is especially important to beginners, because when people are talking about index funds, they usually think about a very broad index. Let's just say the S&P 500, right? However, you can use index funds, targeted index funds, to complement yourself as an investor, as an active investor. So for example, if I'm going to be actively participating in the stock market, then I'm going to be looking at stocks every day, and not necessarily buying or selling every day, but I'm staying up to date as an active investor in the stock markets. And I'm buying stocks in all different types of sectors, but I feel like that I'm lacking exposure in, let's just say, pharmaceutical stocks, okay? If that's the case, then I could use index funds, a targeted index fund like that specializes just in pharmaceutical stocks, to complement my overall investing style. And the other approach is that if you do want to park most of your money, the majority of your money, with a broad index, let's just say an index fund, an S&P 500 index fund, right? You can park the majority of your money in that vehicle, the S&P 500 index fund. However, if you really have that itch to buy and sell individual stocks, well, you can have the majority of your money in a broad index fund like that, a well-diversified index fund like that. But then additionally, you could complement that by buying the stock picks that you like. Let's just say, well, you really think Tesla is going to do good, or you really think Microsoft is going to do good. Then you could have the bulk of your money in an index fund, and you could use smaller amounts of money to make your stock picks. But the bulk of your portfolio will revolve around index fund investing. Now, let me answer some really good, commonly asked questions about index funds. Are index funds popular? The answer is yes. Index funds were introduced in 1976. Investing in index funds is the most common form of passive investing. It is estimated that passive investing in the stock market makes up about 15% of the markets. That's the official stat. Some estimates are that it's over 30%. So yes, it's very common, very popular, so this is nothing new. Another good question is, how do you invest in index funds? Okay, so it's very easy. You will need a brokerage account or a retirement account. You pick the index that you want to track, and then you buy shares of that index fund. So it'll be very straightforward. Another very good question is, how much money do you need to invest in index funds? Most index funds have no minimum requirements, so it could be a great way to get started with very little money. And I'll answer this last question. How many index funds should you own? So that's going to depend on how diversified a particular index fund is. If you invest in a well-diversified fund, then you may only need to own one index fund or two index funds. However, if you invest in an index fund that's more targeted, then you may need to own more than one or two in order to create diversification. Now, it's very important that you understand this. There is no one right way to invest in the stock markets. You can successfully pick your own stocks, invest in index funds, invest in ETFs, or a combination of these. I recommend that you choose what is best for you. And to make that determination, it's important that you understand the differences between the three: stock picking, index funds, and ETFs. So personally in the stock market, I do all three. I invest in index funds, I invest in ETFs, and I pick my own stocks. Now, in this section, you will get a better understanding on whether one or two or all three are a good fit for you. I'm going to answer for you, how are index funds and ETFs similar? How are they different? And how do you know which one is right for you? Okay, so I'm going to tell you the truth. The truth is that they are more in common than not. They have more similarities than differences. But I want you to be aware of the differences that could make an ETF or an index fund a deal breaker for you. I want to demonstrate to you what is going on with an index fund. So you can think of it like this. Let's say that you, me, my brother, your neighbor, and my Uncle Bob, we're all pooling money together. And with this pool of money, we're going to buy all the stocks in the S&P 500. And let's just say we do that, and let's just say that you want out. When you want to cash out your portion, the fund has to sell some of its holdings to pay you out. Now let's compare this to an ETF. So with an ETF, an exchange-traded fund, you could think of it like this. Let's just say that you bought all the stocks in the S&P 500, and you packaged them all up into one bundle, and you did that 10 times. And I say to you, hey, can you sell me one of those? And you're like, yeah, sure. And I buy it from you. So it's simply traded from you to me like a stock. So I hope that helps to clarify what is going on. An index fund is a collection of securities that are financed by a pool of investors. An ETF is a collection of securities that are traded between investors. So that's it. That's the difference. But there are a lot of similarities, and let me tell you what those are. Both an index fund and ETF offer you a low-cost solution, diversification, and a proven track record. So index funds and ETFs, they're both passively managed. This means that there's no human that is actively choosing what to invest in. Therefore, index funds and ETFs are low cost. They have a low expense ratio. Now, both index funds and ETFs, they will give you diversification because they hold a variety of assets. And index funds and ETFs generally outperform active fund managers over a longer period of time. Now, I want to tell you the differences, and this will help you determine which one is better for you. So the four biggest differences between an index fund and ETF are liquidity, minimum investment requirements, expenses and fees, and taxation. So let's get started with liquidity. You can buy and sell ETFs throughout the trading day like a stock. With an index fund, you can only buy or sell at the end of the day. Therefore, an ETF is more liquid. So this probably will not make a big difference for most long-term investors, but it does matter if you're going to do any day trading or shorter duration moves. Now, moving on to minimum investment requirements. So generally, an ETF will have a lower minimum investment requirement when you compare it to an index fund. So for example, you can buy as little as a single share of an ETF. In some cases, you can even buy fractional shares of an ETF. But with some index funds, they're going to impose a minimum requirement. It could be $1,000, it could be $2,000, or even more. Now, when it comes to expenses and fees, both index funds and ETFs are low-cost investments. That's because both are passively managed. Previously, ETFs were known to carry lower expense ratios compared to index funds, but that gap has been closing. And the expenses for index funds and ETFs are now quite similar. So you're going to see expense ratios in the 0.05% to 0.02% range, which is a fraction of 1%, which is a very low-cost solution. And of course, we have to consider taxation. ETFs are more tax efficient compared to index funds. That's because of their structuring. So I previously demonstrated to you how they're structured, and that structuring, it has tax consequences. So essentially with an ETF, you're selling to another buyer, and the cash comes directly from that buyer. To cash out of an index fund, you have to redeem it from the fund manager. And the fund manager will have to sell some of the holdings to get the cash to pay you out. So if there is a gain on the sale, that gain is passed on to all investors of the fund. That means that you can end up with a tax bill even if you don't sell a single share. So ultimately, assets are bought and sold every time an investor enters or leaves an index fund. And anytime there's a capital gain, every investor that's part of the fund will need to pay capital gains tax. Now, I want to be very clear with you on this topic of taxation because I don't want this to scare you. So this is going to be in relation to how much money that you have in the index fund. So if you have very little money in the fund, then don't expect the tax consequences to be significant. But if you do have a lot of money in the index fund, then yes, it could be a decent amount. Now, let me give you my opinion on which one is better, an index fund or an ETF. But I want to tell you this story to help you understand the situation, the whole situation. So the index fund was created in 1975 by John Bogle, who went by the name of Jack. So Jack Bogle was the founder of the Vanguard Group. Bogle created the index fund in 1975 so that everyday investors could compete with the pros. So that was 1975. It took a few years for index fund investing to catch on, but eventually it gained traction. So 18 years passed by, it's 1993. State Street Global launches the S&P 500 ETF called the SPDR. It's referred to as the Spider. But this wasn't the first ETF. This was preceded by the Toronto ETF in 1990, among others. But ultimately, the ETF is an improvement of an index fund. It's like an index fund 2.0. And that's why ETFs have been gaining in popularity very quickly. 1993, the ETF market basically didn't exist. 2002, there are over 100 ETFs. 2009, over 1,000 ETFs. Currently, we're close to 10,000. And right now, there's a competition for your money between index funds and ETFs. Now, let me tell you what I think. My opinion is that an ETF is an upgraded version of an index fund. And here's why. If you're on a tighter budget, an ETF may be better for you if you have less money to invest up front. So I'm referring to the higher minimum requirements. So ETFs, yes, they do have a better tax structuring, and that's going to give you a greater control of claiming gains or losses. And because you can sell, so you can buy or sell an ETF throughout the day, so if that need ever arose, I'm guessing in most situations that it would not, but if it ever did, that you could take advantage of that situation of any major price movements throughout the day, and that is a benefit that you cannot have or do with an index fund. However, some of these ETF advantages, they might not make a meaningful difference to you, especially if you're a long-term investor. So I want to be clear that I do like index funds, but if I had to choose, then I would go with an ETF, but that is just my opinion. But if there's a particular index fund that does not have a competing ETF, then yeah, I would buy that index fund. So that's just the way I see it. So to be clear, both index funds and ETFs have my stamp of approval. However, personally, I like to pick my own stocks in addition to index funds and ETFs. Now, if you want to pick your own stocks, then it is essential that you understand the terminology and you know how to read stocks. Because if you don't understand the stock terms, then you're going to be lost. And you're not going to be able to distinguish good stocks from bad stocks. So let's begin with the essentials. So in this next segment, you're going to learn the key data and stats when you're researching a stock. And it doesn't matter if you're looking at a stock screen on your app or a brokerage account or a website. So the information and terminology that I'm about to show you, it's going to be the same no matter where you look. So please follow along and make sure that you fully grasp this info because it'll be critical. We're going to look at finance.yahoo.com. So let's go there. Once you arrive here at this top bar, search bar right here, that's where you're going to put in your ticker symbol. That's your identifying letters of your stock. So let's look at Ally Bank. So Ally Bank is owned by Ally Financial, so let's go there, ALLY, that's the ticker symbol, as you can see right here. We're going to select that. What we're going to do in this tutorial is give you the basic overview of what we are seeing on the screen. Let's begin. As of right now, when we are reviewing Ally Financial, ticker symbol ALLY, the price is $18.43 a share. The market is closed, so this right here, this will not be fluctuating because the market is closed. If the market is open during that